Decentralized exchanges process billions of dollars in trades every day, yet the liquidity providers powering these markets lack a rigorous framework for maximizing their profits. This paper bridges a 40-year-old auction theory breakthrough with cutting-edge blockchain finance. Liquidity providers face a fundamental challenge. Some traders arrive with genuine buying or selling needs, while others possess superior information about asset prices and seek to profit from mispricing. Without a principled strategy, liquidity providers leave money on the table or get systematically exploited. The solution comes from an unexpected place: Nobel laureate Roger Myerson's 1981 Framework for Optimal Auction Design. The authors recognize a deep structural similarity. Just as an auctioneer faces bidders with private valuations, a liquidity provider faces traders with private beliefs about asset prices. Both problems involve extracting value while maintaining incentive compatibility. The mathematical machinery transfers directly. For a mechanism to work, it must satisfy strict mathematical constraints. The demand curve, how many assets the liquidity provider offers at each price, cannot increase as the trader's reported price rises, or traders could game the system. Payments follow a precise integral formula that ties compensation to the allocation schedule. The most striking finding is what the authors call the no-trade gap. Under optimal strategies, there exists a range of reported prices where the liquidity provider refuses to trade at all. This gap isn't a bug, it's the mathematical signature of strategic pricing under information asymmetry. The provider deliberately excludes marginal traders to avoid being picked off by those with superior information. Virtual values transform the optimization landscape. Where competitive markets trade whenever surplus exists, the monopolist liquidity provider uses virtual values to identify trades that maximize expected profit rather than welfare. This creates intentional market friction, a calculated trade-off between volume and margin. When the authors examine the simplest case, uniform price beliefs and linear demand, elegant formulas emerge. The no-trade gap's width directly encodes the severity of adverse selection in the market. As the proportion of informed traders rises, the optimal gap widens, and overall trading volume falls. The framework makes simplifying assumptions that merit scrutiny. Real liquidity providers interact repeatedly with the same traders, opening strategic possibilities beyond this model's scope. The theory assumes perfectly rational Bayesian agents, while actual DeFi participants exhibit behavioral quirks, and critically, the predictions await empirical testing against live market data. By recognizing that market making is mechanism design in disguise, this work gives liquidity providers a principled tool for navigating information asymmetry, proving that sometimes the optimal strategy is knowing when not to trade. Visit emergentmind.com to explore more research at the intersection of theory and practice and create your own video presentation.